Welcome back to another weekly financial and market update. So, a lot to talk about today. We're in the middle of earnings season, and about 20% of companies that are expected to report have reported. The good news of that is 76% of those companies have all beat their expectations, which is really awesome to hear. A lot of us that have been following the markets and looking at our accounts when logging in online will notice that the market has actually dropped this month. Depending upon what index you look at, whether it's the S&P might show down about 3.5%. Other indexes might show a little less, down 2, down maybe 4 or 5, right? There's sort of a mix and match, but the general overall markets have declined this month. Now, what does that mean and what are expectations moving forward? So, in my personal opinion, I think pullbacks or corrections are really never a bad thing, especially during extended bull market runs. So the biggest thing for that, right, is bringing investors back to earth. So it's just getting rid of that, I guess, overexcited sentiment and a sense of overconfidence that can lead to overbought equity conditions, which is really what we've seen over the last month is equities being really overbought. I know even for the strategies that we implement in-house, we've started to shave off some of our equity exposure for clients just because of the fact that we knew equities are overbought and we are due for somewhat of a market pullback. So again, I think it's a good thing. I think they're very healthy for bull market runs. Just know that they are very normal. They are expected from time to time, and there's not an indicator that the markets are doing poorly. Now, with that in mind, right, some investors might say, well, Ben, the expectations around inflation have really changed this year. In the beginning of the year, we had talked about 3 rate cuts, and now maybe we're thinking 2, more likely maybe even just 1 rate cut this year. And you're right. The markets have priced that in already. So markets have declined because of that. The treasury yields, the 10-year treasury yields have climbed to about 4.8%, and they've sort of hung around there. So markets have priced that in, but they priced it in pretty quickly. Emotionally, it can be harder for us to process information, but markets have no emotion, right? They're not human beings. They can't process things on an emotional level. They process data right away. And that's already happened, which is why we're starting to see some of these pullbacks and some of these market declines and volatility over the last few weeks. I think they will start to smooth out, over the next couple of months. One of the biggest indicators for the Fed is the personal consumption expenditures report, which will come out on Friday. So depending upon what happens Friday, that's probably one of their preferred reports to look at as a gauge of inflation. And if those numbers look okay, then I think that'll be good news or a good sign for the Fed to say, we are more comfortable revisiting 1 to 2 rate cuts this year. Most of us, I think, can agree at this point that 3 rate cuts are off the table. So with that in mind, there's a lot going on. We still have another 80% of companies that need to come out and release their earnings report. Some big eyes to watch are Alphabet, Microsoft, and Tesla. So once those 3 tech giants come out, we'll have a better understanding of where the technology sector is going to be. And of course, they have such a weight to the overall index and stock market that we'll see some changes once those reports are released. So a lot of good information coming out. Again, pullbacks and corrections in bull markets are very normal. They're a healthy thing for the market. And as long as we can remember that and stick to our course, then just know that our long-term investment strategies are going to be just okay. All right, so thanks for tuning in. Enjoy this beautiful day, and I'll see everyone next week. Take care.